This looks good.
I wouldn't buy that if I were you.
Who are you and why would you say that?
My name is Alan, and I am an economist. It has a high amount of indirect tax imposed on it.
What is an indirect tax?
An indirect tax. I will tell you.
Wow. Where are we?
We are in the EIB, the Economics Institute for Beginners. We teach youngsters like yourself about the economy.
But why me? I am not smart.
Nonsense, you're very bright. But you need to learn about a few things so you don't make mistakes like buying expensive products like beer. An indirect tax is a tax imposed on expenditure. There are two types of taxes, specific and percentage taxes. A specific taxes are fixed tax. Whatever the price, the amount of tax imposed is the same. This is specific tax graph. As you can see, the supply curve shifts upwards.
Why does the supply curve shift upwards?
Good question. That is because the costs of the company or firm increases as it takes more money to produce the good because of the tax. P is the equilibrium price and QE is the quantity demanded. This is the amount produced when the market is completely efficient and no outside forces disturb it. As you can see on the graph, the price increases from PE to P1 so the quantity decreases from QE to Q1. Thus the market is not producing efficiently. This is inevitable when imposing taxes. Don't look so worried. It isn't that complicated.
Nothing, it is just a lot of information at once.
Don't worry, it's very easy. Now let's put another graph. The percentage tax. A percentage tax is when the tax is a percentage of the price of the product. What results is that if the product is very expensive, the tax increases. As the specific tax, the price increases so the quantity decreases. The benefit in this tax is the luxury goods are taxed higher so consumers who are rich pay more for their goods.
But what does that have to do with beer?
Oh, for that we have to talk about elasticity, the measure of responsiveness. For our purposes we will only talk about price elasticity of demand. This is the amount of quantity demanded that changes when price changes. There are three types. First is unit elastic demand where price change is directly proportional to quantity demanded. Second is elastic demand where a change in price means that quantity demanded changes a lot more. Third is inelastic demand where a change in price will lead to a smaller change in quantity demanded. These are usually necessary goods like milk or other goods like alcohol. When we graph these different elasticities, the slope of the demand curve changes. The black curve is the unit elastic curve, the red is inelastic and the blue is elastic. This affects how much the consumers and the producers pay for the taxes. When demand is elastic, producers pay more of the tax than consumers. As you can see on the graph, the red box is bigger than the green box. That shows the producers pay more. The red box is called producer burden while the green box is called the consumer burden. Both the boxes together is called the government tax revenue. With this graph, the demand is inelastic so the green box is bigger than the red box so the consumers pay more of the tax than the producers. Governments impose indirect taxes on goods which have inelastic demands such as cigarettes and alcohol since the quantity demanded doesn't change so the firm isn't affected severely. But also since the consumers pay the majority of the taxes the government protects the firm from ending up in bankruptcy while still gaining revenue. Now let's take you back to the real world.
Wait, this wasn't the real world?
I hope you now understand why it's not good to buy alcohol in our economy, where there are huge amounts of indirect taxes on it.
Yes, I do understand. Now if I want to buy alcohol I will go to duty-free shops in airports where there are no taxes.
Ha 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 ha.